Hello, and welcome to the 2020 Last Chance Financial Planning Checklist. I love this checklist because this highlights ways you can take control over your financial lives. We can't control who gets elected, what the markets do, and what the changing laws are. But I highly encourage you to take a moment and complete this checklist and take advantage of the items that you can control so you don't have to worry about your financial future. We're going to start off talking about taxes, and there's a couple of things that I'd like for you to be aware of. We have marginal tax rates. This is based on your taxable income. And then you have adjusted gross income. Adjusted gross income is the income before you take deductions and exemptions. The adjusted gross income usually dictates what is deductible and what is not. At the beginning of the year, we had something called the Secure Act that was passed. The highlights of the Secure Act were raising the required minimum distribution age to age 72, as well as eliminating the stretch IRA benefit for non-spouse beneficiaries. Non-spouse beneficiaries have to take IRA distributions within 10 years. The kiddie tax was reinstated, and those of you working beyond age 70 and a half can still contribute to retirement plans. These were some of the provisions. And then COVID struck. Things got a little discombobulated, didn't they? Well, the CARES Act came into being, and one of the biggest items in the CARES Act was the elimination of required minimum distributions for 2020. Let's look at the tax section. No one wants to pay more than their fair share, correct? Okay. Joe Biden appears to be targeting high income earners. Those earners right now, I've been reading, are earners that have earned income of over $400,000. Let's talk about earned income. Earned income includes taxable employee compensation and net earnings from self-employment. So we want to project income for 20 and 2021. Why? Because we know tax brackets are low this year. Tax brackets could go up next year. If you push income into this year, you know what your bracket is going to be. So let's say you have some stock options you're thinking about exercising next year. You may want to accelerate that into this year. Again, with any tax strategy, consult your tax advisor. This is a great time of the year to contact your tax advisor before tax season starts. Compare 2020 income to 2019 income and your withholding. Make sure you're on track for estimated payments and withholding to prevent penalty. Do you intend to sell a large asset next year? You may want to accelerate it into this year. Or did you sell a large asset this year? This income can affect your adjusted gross income. Again, please consult your tax advisor. They may be able to do a pro forma tax return for you for 2020 to prevent surprises. And you also have time to take into consideration ways of reducing your tax bill before December 31st. Project investment income for non-retirement accounts. Your Commonwealth statement provides you a running tabulation of your investment earnings. This is on page 2. Mainly, this is dividend and interest income. Capital gains are generally paid out in December by mutual funds. If you need an estimate of what your potential capital gain implication could be from mutual funds, please call or email me. Whether or not you reinvest capital gains, you still owe the tax on them. Review realized and unrealized gains and losses. In March of this year, when the market dipped, I sold assets that were at a loss. Well, why did I do this? Well, I call this making lemonade out of lemons. Capital losses offset dollar for dollar capital gains. Capital gains taxes could go up next year. In addition, traditionally, when someone passes away, their assets get a step up in basis. Meaning if you bought a house for $50,000 and you passed away today and that house is worth $1 million, your beneficiaries would inherit an asset and the cost basis would be $1 million. They could turn around and sell it and owe 0 tax. However, if this step up in basis goes away, they turn around, sell the house, they'll owe tax on $950,000 worth of gain. So it's very, very important that we keep tabs on what's happening with capital gains taxes for next year. It's important to know the cost basis of your securities. This is generally reported on your 1099. The IRS gets the proceeds, but they don't know what you earned on that at the sale, but they don't know what you paid. And that's what a Schedule D is for. Also, if you are using Investor 360 and you are paperless, your tax documents will be posted on Investor 360 as soon as they are available. If you want hard copies of your tax documents, please adjust your paperless settings so tax documents are mailed to you. If you sold real estate this year, again, talk to your tax advisor and do a pro forma return to prevent surprises. Check loss carry forwards. Your tax advisor keeps a running tab of this. If you do not have a tax advisor or you want to know what kind of tax losses you may have this year from the result of my activity, please call or email me. Review potential deductions and credits. Most of us don't have the opportunity to take advantage of tax credits, but we do have deductions, and some common deductions are a home office deduction, alimony if your divorce is dated 2018 or earlier, an IRA deduction, charity. One thing about the tax code is it incents investor behavior. Contributions to charity, you get a deduction. If you invest in muni bonds for your community to improve infrastructure, schools, water, airports, etc., you get tax-free interest. So consider using charitable deductions to help offset some of your income, especially if you are on the bubble to move into the next tax bracket. Do you have a small business? A qualified business income deduction may be available to you. This will help you save about 20% in taxes. Are you getting some medical procedures? Consider bunching them up in the same year. Medical expenses exceeding 7.5% of your adjusted gross income are deductible. And of course, mortgage interest is deductible. Another trick to lower your taxable income if you are over 70.5, although RMDs are not required, you can still donate money directly from your IRA to a qualified charity. This is called a qualified charitable deduction. When money is donated directly from your IRA to the charity via paperwork, this money is not included in your income. This is also a great way to lower the amounts in taxable IRA accounts. Due to the recent developments and what's projected for the future, it is more important now than ever to generate different buckets of taxable income, including tax-free income. Roth conversions, serial Roth conversions can create a tax-free bucket of income. This is a great year to do conversions. If the tax brackets change for high-income clients next year, Roth conversions could be more costly. You owe the tax now on a conversion, but if we look down the way, this is a method to control your taxable income in the future. We also have to look at what your estimated taxes could be in the future and if a Roth conversion is appropriate. I see large IRAs that when distributed are 100% taxable. Do you think taxes are going to go up in the future? Tax brackets may not change, but limited deductions and adjusted gross income parameters are low-hanging fruit. Due to COVID, the enactment of the Secure Act, it's a whole new ballgame this year and looking forward. Using life insurance as a tax strategy is very important to consider. The last 10 years, life insurance strategies have been out of favor, but not now. And you no longer have to die to use life insurance. Cash value life insurance is a tax preferenced item that can possibly save you and your beneficiaries thousands of dollars in taxes. Let's discuss how a life insurance strategy can save you and your beneficiary money, especially if the step up in basis goes away, or there is also talk of reducing the estate tax exclusion from $11 million to $5 million or maybe less. Beneficiaries may be forced to sell assets in order to pay taxes. Let's move on to section 2, retirement. Max out 401k contributions, including catch-ups. Max out IRA contributions, including catch-ups. Anybody that has earned income can do an IRA. The ability, whether or not it's deductible, whether you can do a Roth, if you have questions about what IRA strategies are available to you, please call or email me. Analyze Roth conversion scenarios. I can help you do a calculation and project how much you would owe with a conversion. Take required minimum distributions. If you need an idea of how much you might have to take next year, please, again, call or email me. Open up a retirement plan if newly self-employed. If you're self-employed, you're able to do a solo 401k or a SEP IRA. Consider Social Security claiming options. If you're thinking of taking Social Security or have a question as to when and how to take Social Security, please contact me. I can do a Social Security analysis for you. Another item I'd like to add to the checklist that isn't on here is Roth 401ks. Many employers are adding Roth 401ks as a new benefit to your 401k plan. The money that goes into a Roth is after-tax dollars, but if you're a high income earner and you can't do a conversion or you can't do a Roth IRA contribution, you could do a Roth 401k. This is a great way to get a Roth bucket of money growing for you. Let's move on to investments. If you have not been in to see me in the last year, call me so we can check on these items. Remember, I invest money based on your goals, priorities, and time frame. If these have changed, your investment plan may have changed, so call me. So what we do in meetings is confirm investment goals and strategy, review asset allocation for rebalancing opportunities, review fundamentals of portfolio positions, revisit income and saving needs. Are you on track to reach your goals? Re-examine asset allocation. Review outstanding loans and mortgages. If you haven't already done so, now may be a great time to refinance your mortgage. Reach out to your mortgage broker and determine if refinancing makes economic sense for you. Review dividend distributions and review employee stock options. Let's move on to insurance. For those of us in California, homeowners insurance will most likely go up, and don't be surprised if you get canceled. Reach out to your agent and get a game plan in place should your homeowners get canceled. Your longtime carrier may no longer be the best option for your car or auto. Your property casualty agent can help assess this for you. Another thing to consider is getting an umbrella liability policy. If you rent your home or an apartment, get renter's insurance. Your landlord's property is covered with their policy, your property is not. Life insurance. Do your survivors have enough money to pay off bills, the mortgage, fund college education? Let's do a life insurance needs analysis. Did you know that life insurance provides tax-deferred growth and tax-free income? With an increasing budget deficit, sequence of return risk, this is now the time to talk and evaluate your options. Life insurance can be a prudent way to grow tax-free income and tax-free distributions to you and your family. Long-term care insurance. Remember, with any insurance, you're leveraging your dollar. You put $1 into a policy. If there's an event, you're going to get $5, $10 more back in return. However, you buy insurance for protection. You don't necessarily want to use it. But long-term care, as we're all getting older and we go into slow go and no go years, long-term care can run up to $60,000 minimum per year. Yeah, you can pull that out of the IRA. That will deplete your IRA account and increase your taxable income. But consider using long-term care insurance. This provides a tax-free benefit if you require care in the future. Let's move on to section 5, milestones. If you're turning 50 next year, remember to contact your plan administrator and change your 401k election to the maximum, which is about I think it's $26,500 next year. Age 55, you can take distributions from 401k plans without penalty if retired. You may not want to roll over your 401k if you are 55 because you could draw from it penalty free. At age 59 and a half, you can take distributions from IRAs without penalty. Starting at age 62, you can take Social Security, but again, contact me if you are planning on taking Social Security. At age 65, you can apply for Medicare. Even if you're not employed, please contact Social Security and make sure that you are exempt from Medicare, even if you're working. You don't want to miss applying for Medicare at age 65 because you're forever penalized with higher premiums. At age 72, you must begin taking RMDs from IRAs. Section 6, health. Review your employer's health insurance plan. Shop state health insurance exchange. Review health savings account contributions for 2020. This is a great way to get a pre-tax deduction and have pay for medical expenses with pre-tax dollars. Review Medicare enrollment options. One item that Joe Biden is kicking around is lowering the Medicare age to age 60. This can be a great opportunity for those of you who are able to retire before age 65, but continue to work, because health insurance generally for a basic plan is over $1,000 a month once you reach age 60. So if Medicare is lowered to age 60, this could be a great opportunity to retire. Let's move on to section 7, which is life changes. These are events that will change your financial plan, possibly. Did you move, sell a major asset, acquire a major asset? Did you transfer any major financial assets? Did you refinance your house, change jobs, lose a job, have a birth, have a death? Did you get married, end a marriage? Did you lose a loved one? Do you have a parent or other family member in need of assisted living? Is there a severe illness in the family? Did you receive a gift or inheritance? These are all items that can affect your financial planning. So please contact me if you'd like to discuss. And last but not least, family and intergenerational planning. Let's discuss, because with the Secure Act, inherited IRAs must be distributed within 10 years of death. This is taxable income to beneficiaries. This could also put your beneficiaries into a very high tax bracket. Your hard-earned savings can be taxed away. Let's talk about using charity. There are many different types of charitable trusts that could create a deduction, tax preferenced income, and doing good in the world. Review and fund trusts. If you have a living trust, please let me know, especially if your account is in the name of your individual name and not in the name of the trust. Remember, IRAs, 401ks, annuities should never be in the name of your trust. Those are okay to be individual. If you have an individual trust or an individual account and you don't have a trust, contact me. We could change the title to a transfer on death. That operates very much like a trust would. Call me for details. Utilize 529 plans. For older parents, Roth IRAs are a great way to pay for kids' educations. Wow, so many ideas. The economy, taxes, regulations, your life, nothing stays the same. This is why I encourage you to be an active participant in your financial planning. I wish I could do it all for you, but I can't without your participation. If you would like a checkup or discuss anything on the checklist, please call or email me and we will set up a review for you. I hope you have a great day and I hope you found this informative. Thank you and have a wonderful day.